Moving on to our next section, I would like to pivot our focus into the more technical aspects of trading. We can begin by taking a look at the different types of orders that can be placed when entering and exiting a given trade. So, an order is an instruction to buy or sell a security. Anytime a trade is entered or exited, an order must be put in place. These orders are typically sent to your broker, who then processes the order, finds an opposing order to match, and executes based on the instructions that were provided. Luckily for us, most of these complications are dealt with by your broker, so all you have to do is choose what order to place. Brokers often automate order executions as well, which allows for near instantaneous feedback. With that being said, let's dive into the different types of orders that a trader may use. A market order is an order to buy or sell a security immediately, which is done at the current market price. It is important to consider that market orders may not necessarily be executed at the current market price, which is known as slippage. And this is essentially due to the variance in liquidity. Remember, liquidity can be defined as how easily something can turn into money. In other words, how easily can your order be executed? If an individual were to place a market sell order when price is going down aggressively, there may not be enough buy orders for your broker to match your sell order with, which means that the broker will have to find the closest buy order to your sell order, which can lead to slippage. Now, something else to keep in mind with slippage is that your broker will typically give you the unfavorable order. You should never anticipate on getting a better execution due to slippage. Now, there is one way to avoid slippage, and that could be by participating in highly liquid markets. As we have mentioned before, foreign exchange markets are some of the most liquid markets out there. Other highly liquid markets include indices such as the S&P 500 or the Nasdaq 100. Commodities such as gold or crude oil are also very liquid and will typically show less slippage to the trader. The second type of order that we will look at is the limit order, which is an order to buy or sell at a certain price in the future. Unlike market orders, a limit order is placed in the future at a price that the trader is comfortable entering at. Typically, traders enter and exit trades based on certain confirmations that the market or external properties provide. Instead of waiting at the exact moment of entry, using a market order, a limit order can be placed in advance, which saves the trader from potentially missing their opportunity or making any rash decisions. An order placed in the future also allows the trader more time to determine entry and exit points, which can help in determining risk. Although what really separates limit orders from market orders is their resistance to slippage. This is because the limit orders can only be executed at the price that you instructed it to be executed at. Now, keeping this in mind, you may think, why would anyone use a market order ever? If a market order is submitted at the exact same price as a limit order, why may slippage only occur on the market order? While the limit order is resistant to slippage, it is also at risk of not being executed at all. While a market order will execute the order with certainty, a limit order will only do so if there is an opposing order to match at that exact price. If there is no order to match, the limit order will not be executed. The third type of order is known as a stop order. A stop order will exit the current position at the current price or at a certain price in the future. Unlike market and limit orders, stop orders are used explicitly for exiting a position and cannot be used to enter a position. They are designed to help the trader determine risk and profit levels, both of which are crucial when developing a plan. A trailing stop order is a type of stop order that follows a price at a certain percentage or dollar amount away from the current price. This helps lock in profits as it allows the position to remain open and continue to make unrealized profits as long as the price is moving in the trader's favor. It is also important to understand that the trailing stop order will never move against the anticipated direction, meaning it will never increase the risk that you are putting on. It will only lessen the risk or remain flat. Trailing stop orders are generally placed as market orders since they have the ability to move freely. The next and final type of order, which is more so a categorization of orders, are bracket orders. There are many different types of bracket orders, but the configuration is what's important, so that is what we will focus on. A bracket order contains multiple buy and sell orders, which generally include entry-based orders and exit-based orders. In simpler terms, a bracket order does all the work for you, so long as you have determined the proper entries and exits based on your plan. An example of a typical bracket order will have 3 parts, an entry and 2 exits. The entry, of course, is where you anticipate on entering your position, which is then followed by 2 exit points. One exit will be the point at which you exit for a profit, and the other exit will be the point where you exit for a loss. Remember, defining your risk and your profits are crucial to success in the markets. Now, something I have learned over my years of study in regards to the financial markets is that diagrams and visual examples are some of the best ways to transfer knowledge. To that, I have created some visual examples of the types of orders that you may encounter. Here we have a trader, say his name is Thomas, who is actively watching a given stock shown on the right. Based on the price action shown, we can see that the price is at $101. Our trader, Thomas, wants to enter a long position right now. To do so, he will place a market buy order at the current price, which is $101. Assuming no slippage, Thomas has now entered at $101 for his long position. Thomas soon realizes that he must find exit points for his long position and places a sell limit order at $106, which is the price Thomas is comfortable with exiting for a profit of $5. This order is represented as the dotted red line at the price level 106. Thomas also needs to determine his risk, which he decides should be $2. This means that Thomas places his sell stop order at 99, which is indicated by the dotted red line at price level 99. Now, Thomas can let price run without having to make any future decisions. After having some breakfast, Thomas comes back to his chart and realizes that his position hit his sell limit for $5 profit. When we look back at how Thomas placed his orders, we can see that he placed 3 separate orders, 1 market order, 1 limit order, and 1 stop order. To make this an easier process, Thomas can place a bracket order, which will provide 1 entry and 2 exits. Of course, the price levels must still be determined when using a bracket order, except this can be done in advance, which allows Thomas to trade more effectively. This also eliminates the need to cancel orders which were never executed, such as the stop order in the example shown here at $99. Since this order never hit, it will remain there until it is executed or canceled by the trader. This would not be a problem when utilizing a bracket order.